One morning, you open your banking app and see it. Your loan payment has increased. You didn't borrow more money. You didn't miss a payment. You didn't change anything. But interest rates went up, and now your monthly payment is eating a bigger chunk of your income. This is the reality for millions of Americans right now. When central banks raise interest rates to fight inflation, the effects don't stay in government buildings or financial markets. They show up in real life. They show up in your mortgage payment, your business loan, your car loan, and your monthly budget. The frustrating part is that many people feel trapped. How am I supposed to manage this now? The answer starts with understanding that higher rates change the rules of the game. The businesses and households that survive these periods are not necessarily the ones earning the most money. They are the ones that adjust the fastest. That means reviewing expenses, renegotiating debts where possible, improving cash flow, building additional income streams, and making financial decisions based on today's reality instead of yesterday's conditions. HIG rates are difficult, but they are also temporary. Every economic cycle eventually changes. The question is not whether rates went up. The question is, what adjustments are you making to stay ahead while they remain high? When interest rates rise, most people focus on the headline. The Federal Reserve raises rates. The news talks about inflation. Financial experts debate what happens next, but for ordinary households and business owners, the story is much simpler. A higher interest rate means borrowing becomes more expensive. Your mortgage payment may increase. Your business loan may cost more. Your credit card balance becomes harder to pay off. Your vehicle loan suddenly takes a bigger bite out of your monthly income. And that leads many people to ask the same question: how am I supposed to manage this now? The truth is that rising interest rates create financial pressure, but they also reveal something important. They expose the difference between reacting emotionally and responding strategically. Smart borrowers do not panic when rates rise. They assess, they adjust, they adapt. The first thing smart borrowers do is understand their numbers. They know exactly how much debt they owe, what interest rates they are paying, and how much of their monthly income is committed to debt payments. You cannot solve a financial problem you have not measured. The second thing they do is focus on cash flow. Many people think wealth is about income. In reality, survival during periods of rising interest rates is often about cash flow. A family earning $120,000 a year can struggle if every dollar is already committed. A business generating strong sales can still experience financial stress if cash is leaving faster than it is coming in. That is why smart borrowers review subscriptions, recurring expenses, unnecessary spending, and inefficient business costs. Every dollar saved strengthens financial flexibility. Third thing they do is attack high-interest debt aggressively. And all debt is equal. A mortgage at a reasonable rate is very different from carrying a large credit card balance at a much higher rate. The faster expensive debt is reduced, the less vulnerable you become when rates continue climbing. The fourth thing they do is build additional income streams. This is where many people miss an opportunity. During periods of higher rates, relying on a single source of income can be risky. Smart borrowers look for ways to increase earnings through freelance work, consulting, side hustles, online services, or monetizing existing skills. You do not always solve a cash flow problem by cutting expenses. Sometimes you solve it by increasing income. The fifth thing they do is avoid making new debt problems when money feels tight. It is their ability to adapt when conditions change. The borrowers who thrive during periods of rising interest rates are not necessarily the richest. They are the most informed. They understand their numbers. They manage their cash flow. They reduce expensive debt. They create additional income. And they make decisions based on financial reality rather than financial hope. The question is not whether rates are rising. The question is whether your financial strategy is rising with them. Have rising interest rates affected your finances this year? Type one of these in the comments. A mortgage payment increased. B. Credit card costs increased. C. Business loan became more expensive. D. No major impact, yet I'd love to hear your experience and how you're adjusting. Subscribe to the Plain Business Network for practical lessons on business, money, accounting, cash flow, side hustles, and the economy explained in plain language. If you want financial education without jargon, you're in the right place.